Please select desired text on the website first. You can also select text. Open a ZERODHA account. Chapter 1. Background, Forwards Market. 1.1 Overview. The futures market is an integral part of the financial derivatives world. Derivatives, as they are called, is a security whose value is derived from another financial entity referred to as an underlying asset. The underlying asset can be anything as stock, bond, commodity, or currency. The financial derivatives have been around for a long time now. The earliest reference to the application of derivatives in India dates back to 320 BC in Kautilya's Arthashastra. It is believed that in the ancient Arthashastra, study of economics, script, Kautilya described the pricing mechanism of the standing crops ready to be harvested at some point in the future. Apparently, he used this method to pay the farmers much in advance, thereby structuring a true forwards contract. Given the similarities between the forwards and the futures market, I think the best possible way to introduce the futures market is by first understanding the forwards market. The understanding of forwards market would lay a strong foundation for learning the futures market. The forwards contract is the simplest form of derivative. Consider the forwards contract as the older avatar of the futures contract. Both the futures and the forward contracts share a common transactional structure, except that over the years the futures contracts have become the default choice of a trader. The forward contracts are still in use, but are limited to a few participants such as the industries and banks. The focus of this chapter is to help you understand the structure of a typical forwards transaction, after which we will break it down to its elements and understand its advantages and disadvantages. 1.2 A simple forwards example. The forward market was primarily started to protect the interest of the farmers from adverse price movements. In a forward market, the buyer and seller enter into an agreement to exchange the goods for cash. The exchange happens at a specific price on a specific future date. The price of the goods is fixed by both the parties on the day they enter into the agreement. Similarly, the date and time of the goods to be delivered is also fixed. The agreement happens face-to-face with no intervention of a third party. This is called over-the-counter or OTC agreement. Forward contracts are traded only in the OTC, over-the-counter, market, where individuals, institutions trade through negotiations on a one-to-one basis. Consider this example. There are two parties involved here. One is a jeweler whose job is to design and manufacture jewelry. Let us call him ABC Jewelers. The other is a gold importer whose job is to sell gold at a wholesale price to jewelers. Let us call him XYZ Gold Dealers. On the 9th of December 2014, ABC enters into an agreement with XYZ to buy 15 kilograms of gold at a certain purity, say 999 purity, in 3 months' time, the 9th of March 2015. They fix the price of gold at the current market price, which is 2,450 rupees per gram or 24 rupees, 50,000 per kilogram. Hence, as per this agreement, on the 9th of March 2015, ABC is expected to pay XYZ a sum of 3 rupees 0.675 CRS 24, 50,000 per kilograms *15 in return for the 15 kgs of gold. This is a very straightforward and typical business agreement that is prevalent in the market. An agreement of this sort is called forwards contract or a forwards agreement. Denote: the agreement is executed on the 9th of December 2014. Hence, irrespective of the price of gold 3 months later, i.e. the 9th of March 2015, both ABC and XYZ are obligated to honor the agreement. Before we proceed further, let us understand the thought process of each party and understand what compelled them to enter into this agreement. Why do you think ABC entered into this agreement? Well, ABC believes the price of gold would go up over the next 3 months. Hence, they would want to lock in today's market price for the gold. Clearly, ABC wants to insulate itself from an adverse increase in gold prices. In a forwards contract, the party agreeing to buy the asset at some point in the future is called the buyer of the forwards contract. In this case, it is ABC Jewelers. Likewise, XYZ believes the price of gold would go down over the next 3 months and hence they want to cash in on the high price of gold which is available in the market today. In a forwards contract, the party agreeing to sell the asset at some point in the future is called the seller of the forwards contract. In this case it is XYZ gold dealers. Both the parties have an opposing view on gold. Hence they see this agreement to be in line with their future expectation. 1.3 to 3 possible scenarios. While both these parties have their own view on gold, there are only 3 possible scenarios that could pan out at the end of 3 months. Let us understand these scenarios and how it could impact both the parties. Scenario 1. The price of gold goes higher. Assume on the 9th of March 2015. The price of gold 999 purity is trading at 2,700 rupees per gram. Clearly, ABC Jewelers' view on the gold price has come true. At the time of the agreement, the deal was valued at 3 rupees and 67 paise CRS, but now with the increase in gold prices, the deal is valued at 4 rupees and 5 paise CRS. As per the agreement, ABC Jewelers is entitled to buy gold 999 purity from XYZ gold dealers at a price they had previously agreed upon, i.e. 2,450 rupees per gram. The increase in gold price impacts both the parties in the following way. Party action financial impact. ABC Jewelers buys gold from XYZ gold dealers at 2,450 rupees per gram. ABC saves 38 lakh rupees, 4.05 CRS, 3.67 CRS by virtue of this agreement. XYZ gold dealers obligated to sell gold to ABC at 2,450 rupees per gram incurs a financial loss of 38 lakh rupees. Hence, XYZ gold dealers will have to buy gold from the open market at 2,700 rupees per gram and would have to sell it to ABC Jewelers at the rate of 2,450 rupees per gram, thereby facing a loss in this transaction. Scenario 2. The price of gold goes down. Assume on the 9th of March 2015. The price of gold 999 purity is trading at 2,050 rupees per gram. Under such circumstances, XYZ gold dealers' view on the gold price has come true. At the time of the agreement, the deal was valued at 3.67 crore rupees, but now with the decrease in gold prices, the deal is valued at 3.075 crore rupees. However, according to the agreement, ABC Jewelers is obligated to buy gold 999 purity from XYZ gold dealers at a price they had previously agreed upon, i.e. 2,450 rupees per gram. This decrease in the gold price would impact both the parties in the following way. Party action financial impact. ABC Jewelers is obligated to buy gold from XYZ gold dealers at 2,450 rupees per gram. ABC loses 59 rupees and 50 paise. Locks 3.67 CRS, 3.075 CRS by virtue of this agreement. XYZ gold dealers entitled to sell gold to ABC at 2,450 rupees per gram. XYZ enjoys a profit of 59.5 lakh rupees. Denote: even though gold is available at a much cheaper rate in the open market, ABC Jewelers is forced to buy gold at a higher rate from XYZ gold dealers, hence incurring a loss. Scenario 3. The price of gold stays the same. If on the 9th of March 2015, the price is the same as on the 9th of December 2014, then neither ABC nor XYZ would benefit from the agreement. 1.4 to 3 possible scenarios in one graph. Here is a visual representation of the impact of gold prices on ABC Jewelers. As you can see from the chart above, at 2,450 rupees per gram, there is no financial impact for ABC. However, as per the graph above, we can notice that ABC's financials are significantly impacted by a directional movement in the gold prices. Higher the price of gold, above 2,450 rupees per, higher is ABC's savings or the potential profit. Likewise, as and when the gold price lowers below 2,450 rupees per ABC is obligated to buy gold at a higher rate from XYZ, thereby incurring a loss. Similar observations can be made with XYZ at 2,450 rupees per gram. There is no financial impact on XYZ. However, as per the graph above, XYZ's financials are significantly impacted by a directional movement in the gold prices. As and when the price of gold increases above 2,450 rupees per, XYZ is forced to sell gold at a lower rate, thereby incurring a loss. However, as and when the price of gold decreases below 2,450 rupees per, XYZ would enjoy the benefit of selling gold at a higher rate at a time when gold is available at a lower rate in the market, thereby making a profit. 1.5 A quick note on settlement. Assume that on the 9th of March 2015, the price of gold is 2,700 rupees per gram. Clearly, as we have just understood, at 2,700 rupees per gram, ABC Jewelers stands to benefit from the agreement. At the time of the agreement, the 9th of December 2014, 15 kgs gold was worth Rs. 3.67 CRS. However, as on the 9th of March 2015, 15 kgs gold is valued at 4 rupees and 5 paise CRS. Assuming at the end of 3 months, i.e. the 9th of March 2015, both the parties honor the contract. Here are two options available to them for settling the agreement. Physical settlement: the full purchase price is paid by the buyer of a forward contract and the actual asset is delivered by the seller. XYZ buys 15 kgs of gold from the open market by paying 4 rupees and 5 paise CRS and would deliver the same to ABC on the receipt of 3 rupees and 67 paise CRS. This is called physical settlement. Cash settlement: in a cash settlement, there is no actual delivery or receipt of a security. In cash settlement, the buyer and the seller will simply exchange the cash difference. As per the agreement, XYZ is obligated to sell gold at 2,450 rupees per gram to ABC. In other words, ABC pays 3 rupees and 67 paise CRS in return for the 15 kgs of gold, which is worth 4.05 crore rupees in the open market. However, instead of making this transaction, i.e. ABC paying 3 rupees and 67 paise CRS in return for the gold worth 4 rupees and 5 paise CRS, the two parties can agree to exchange only the cash differential. In this case, it would be 4 rupees and 5 paise CRS, 3 rupees and 67 paise CRS equals 38 lakh rupees. Hence XYZ would just pay 38 lakh rupees to ABC and settle the deal. This is called a cash settlement. We will understand a lot more about settlement at a much later stage. But at this stage you need to be aware that there are basically two basic types of settlement options available in a forwards contract: physical and cash. 1.6 What about the risk? While we are clear about the structure, terms and conditions of the agreement and the impact of the price variation on either party, what about the risk involved? Denote: the risk is not just with price movements. There are other major drawbacks in a forward contract, and they are liquidity risk. In our example, we have conveniently assumed that ABC, with a certain view on gold, finds a party XYZ who has an exact opposite view. Hence they easily strike a deal. In the real world, this is not so easy. In a real-life situation, the parties would approach an investment bank and discuss their intention. The investment bank would scout the market to find a party who has an opposite view. Of course, the investment bank does this for a fee. Default risk, counterparty risk. Consider this. Assume the gold prices have reached 2,700 rupees per at the end of 3 months. ABC would feel proud about the financial decision they had taken 3 months ago. They are expecting XYZ to pay up. But what if XYZ defaults? Regulatory risk. The forwards contract agreement is executed by a mutual consent of the parties involved, and there is no regulatory authority governing the agreement. In the absence of a regulatory authority, a sense of lawlessness creeps in, which in turn increases the incentive to default. Rigidity. Both ABC and XEY entered into this agreement on the 9th of December 2014 with a certain view on gold. However, what would happen if their view would strongly change when they are halfway through the agreement? The rigidity of the forward agreement is such that they cannot foreclose the agreement halfway through. The forward contracts have a few disadvantages, and hence future contracts were designed to reduce the risks of the forward agreements. In India, the futures market is a part of a highly vibrant financial derivatives market. During the course of this module, we will learn more about the futures and methods to efficiently trade this instrument. So, let's hit the road. Key takeaways from this chapter. The forwards contract lays down the basic foundation for a futures contract. A forward is an OTC derivative, which is not traded on an exchange. Forward contracts are private agreements whose terms vary from one contract to the other. The structure of a forwards contract is fairly simple. In a forward agreement, the party agreeing to buy the asset is called the buyer of the forwards contract. In a forward agreement, the party agreeing to sell the asset is called the seller of the forwards contract. A variation in the price would have an impact on both the buyer and the seller of the forwards contract. Settlement takes place in two ways in a forward contract: physical and cash settlement. The risk of a forward contract is reduced by a futures contract. The core of a forward and futures contract is the same. 24 responses to background. Open a ZERODHA account. Chapter 2. Introducing futures contract. 2.1 Setting the context. In the previous chapter, we looked at a very simple forwards contract example, wherein two parties agreed to exchange cash for goods at some point in the future. We inspected the structure of the transaction and understood how the variation in price impacts the parties involved. Towards the end of the chapter, we had listed down 4 key risks or issues with respect to the forwards contracts, and we concluded that a futures contract is structured to overcome the critical risks of a forward agreement, namely liquidity risk, default risk, regulatory risk, rigidity of the transitional structure. We will continue referring to the same example in this chapter as well. Hence, you may want to refresh your understanding of the example quoted in the previous chapter. From the previous chapter, one thing is quite clear: if you have a view on the price of an ASO, you can benefit significantly by entering into a forward agreement. All one needs to do is to find a counterparty willing to take the opposite side. Needless to say, a forward agreement is limited by the inherent risks involved, all of which is overcome by a futures agreement. The futures contract or futures agreement is an improvisation of the forwards agreement. The futures contract is designed in such a way that it retains the core transactional structure of a forwards market, and at the same time, it eliminates the risks associated with the forwards contract. A forward agreement would give you a financial benefit as long as you have an accurate directional view on the price of an ASO. This is what I mean when I say core transactional structure. This may seem a bit absurd, but think about it. The transaction structure of an old generation car was just to transport you from point A to point B. However, the new generation car comes with improvisations in terms of the safety features: airbags, seat belts, ABS, power steering, etc. But it still retains the core transaction structure, i.e. to help you move from point A to point B. This is the same distinction between the forwards and the futures agreement. 2.2a Sneak peek into the futures agreement. As we now know that the core transactional structure of the futures and forwards is the same, I guess it makes sense to look into the features that distinguishes the futures from the forwards. We will have a quick sneak peek into these features in this chapter, but at a later stage we will dig into each and every feature in greater detail. Recall, in the example we had quoted in the previous chapter, ABC Jeweler enters into an agreement with XYZ to buy a certain quantity of gold at a certain point in the future. Now imagine this. What if ABC found it really hard to find XYZ as a counterparty to the agreement? Under such circumstances, though ABC has a certain view on gold and is also willing to enter into a financial agreement, they would be left helpless simply because there is no counterparty to take the opposite side of the agreement. Now further imagine this. What if ABC, instead of spending its time and effort to scout for a counterparty, simply decides to walk into a financial supermarket where there are many counterparties willing to take the opposite view? With such a financial supermarket in place, ABC has to just announce its intention and the willing counterparties would line up to take the opposing stance. But more, a true financial supermarket of this sort would not just have people with a view on gold, but instead will also have people with a view on silver, copper, crude oil, and pretty much any asset class including stocks. In fact, this is exactly how the futures contracts are made available. They are available and accessible to all of us and not just available to a corporate such as ABC Jewelers. The futures contracts are available to us in the financial supermarket, often called the exchange. The exchange can be a stock exchange or a commodity exchange. As we know, a futures contract is structured a little differently compared to a forwards contract. This is mainly to overcome the risks involved in the forwards market. Let us look at each of these points that differentiate the futures from the forwards agreement. Note: after reading through the following points, you may still not be very clear about futures. That's alright. Just keep the following points in perspective. We will shortly consider a futures example, and with that you should be clear about the way in which futures agreement works. Futures contract mimics the underlying. In the example of ABC Jewelers and XYZ Gold Dealers, the forwards agreement was based on gold as an asset and its price. However, when it comes to a futures contract, the agreement is based on the future price of the asset. The futures price mimics the ASO, which is also called the underlying. For example, gold as an asset can have a gold futures contract. Think of the underlying and its futures contract somewhat as twin siblings. Whatever the underlying asset does, the futures contract is the same. Therefore, if the price of the underlying goes up, the price of the futures contract would also go up. Likewise, if the price of the underlying goes down, the price of the futures contract also goes down. Standardized contracts. Again, going back to the example of ABC Jewelers and XYZ Gold Dealers, the agreement was to deal with 15 kgs of gold of certain purity. If both the parties mutually agreed, the agreement could have been for 14.5 kgs or 15.25 kgs or whatever they would think is convenient for them. However, in the futures contract, the parameters are standardized. They are not negotiable. Futures contracts are tradable. The futures contract is easily tradable, meaning if I get into an agreement with counterparty, unlike a forward contract, I need not honor the contract till the end, also called the expiry day. At any point in time, if my view changes, I can just transfer the contract to someone else and get out of the agreement. Futures market is highly regulated. The futures markets, or for that matter, the entire financial derivatives market, is highly regulated by a regulatory authority. In India, the regulatory authority is Securities and Exchange Board of India, SEBI. This means there is always someone overlooking the activities in the market and making sure things run smoothly. This also means default on a futures agreement is hardly a possibility. Futures contracts are time-bound. We will understand this point in detail a bit later, but for now, do remember that all the futures contracts available to you have different time frames. In the example from previous chapter, ABC Jewelers had a certain view on gold, keeping 3 months in perspective. If ABC were to do a similar agreement in the futures market, contracts would be available to them in the 1 month, 2 month, and 3 month time frame. The time frame up to which the contract lasts is called the expiry of the contract. Cash settled. Most of the futures contracts are cash settled. This means only the cash differential is paid out. There is no worry of moving the physical asset from one place to another. More so, the cash settlement is overseen by the regulatory authority, ensuring total transparency in the cash settlement process. To sum up, here is a table that quickly summarizes the difference between the forwards contract and futures contract. Forwards contract, futures contract. Contracts are traded over the counter. OTC futures contract are traded in the exchange. Contracts can be customized. Future contracts are standardized. High counterparty risk. No counterparty risk. Not regulated. Regulated by SEBI in India. Contracts are not transferable. Transferable, hence easily tradable. Time bound to just one time frame. Multiple time frame contracts available. Settlement is flexible, physical or cash settled. At this stage, I feel there is a need to stress upon the distinction between the spot price and the future price. The spot price is the price at which the asset trades in the regular market, also called the spot market. For example, if we are talking about gold as an underlying, then there are two prices we are referring to: gold in the regular market, also called the spot market, and gold in the futures market, called the gold futures. The prices in the spot market and futures market move in tandem, meaning if one goes up, the other also goes up. With these points in perspective, let us now move our attention to a few other nuances of the futures contract. 2.3 Before your first futures trade. Before we dig deeper and understand the working of a futures contract, we need to understand a few other aspects related to futures trading. Do remember, at a later stage we will revisit these points and discuss them in greater detail. But for now, a good working knowledge on the following points is what is required. Lot size. Futures is a standardized contract where everything related to the agreement is predetermined. Lot size is one such parameter. Lot size specifies the minimum quantity that you will have to transact in a futures contract. Lot size varies from one asset to another. Contract value. In our example of ABC Jeweler and XYZ Gold Dealers, ABC agreed to buy 15 kgs of gold at the rate of 2,450 rupees per gram, or 24 rupees 50,000 per kilogram. Since the deal was to buy 15 kgs, the whole deal was valued at 24 rupees 50,000 by 15 equals 3 rupees 0.675 CRS. In this case, it is said that the contract value is 3 rupees 0.675 CRS. Simply put, the contract value is the quantity times the price of the asset. We know the futures agreement has a standard predetermined minimum quantity, lot size. Going by this, the contract value of a futures agreement can be generalized to lot size x price. Margin, again, referring back to the example of ABC Jeweler and XYZ Gold Dealers. At the time of agreement, i.e. on the 9th of December 2014, both the parties would have had a gentleman's word and nothing beyond that. Meaning both the parties would have just agreed to honor the contract on the agreement's expiry day, i.e. the 9th of March 2015. Do notice there is no exchange of money on the 9th of December 2014. However, in a futures agreement, the moment a transaction takes place, both the parties involved will have to deposit some money. Consider this as the token advance required for entering into an agreement. The money has to be deposited with the broker. Usually, the money that needs to be deposited is calculated as a % of the contract value. This is called the margin amount. Margins play a very pivotal role in futures trading. We will understand this in greater detail at a later stage. For now, just remember that to enter into a futures agreement, a margin amount is required, which is a certain percentage of the contract value. Expiry. As we know, all futures contracts are time-bound. The expiry, or the expiry date of the futures contract, is the date up to which the agreement is valid. Beyond the valid date, the contract ceases to exist. Also be aware that the day a contract expires, new contracts are introduced by the exchanges. With these viewpoints that we have discussed so far, I guess we are now equipped to understand a simple example of futures trading. Key takeaways from this chapter. The forwards and futures markets gives you a financial benefit if you have an accurate directional view on the price of an asset. The futures contract is an improvisation over the forwards contract. The futures price generally mimics the underlying price in the spot market. Unlike a forwards contract, the futures contract is tradable. The futures contract is a standardized contract wherein all the variables of the agreement is predetermined. Futures contracts are time-bound and the contracts are available over different time frames. Most of the futures contracts are cash-settled. The futures market is regulated by SEBI in India. Lot size is the minimum quantity specified in the futures contract. Contract value equals lot size times the futures price. To enter into a futures agreement, one has to deposit a margin amount, which is a certain percent of the contract value. Every futures contract has an expiry date beyond which the contract would cease to exist. Upon expiry, old contracts cease and new ones are created. (33) Responses to introducing futures contract. Open a ZERODHA account. Chapter 3. The Futures Trade. 3.1 Before the trade. In the last chapter, we learned various concepts related to the futures market. Remember, the motivation for any trader entering into a futures agreement is to benefit financially, and for which the trader needs to have a directional view on the price of the underlying asset. Perhaps it is time we take up a practical example of a futures trade to demonstrate how this is done. Also, I guess we should move away from the gold example and look into an example related to the stocks. Today, the 15th of December 2014, the management of Tata Consultancy Services, TCS, a leading Indian software company, had an investors' meet, wherein the TCS management announced that they are cautious about the revenue growth for the December quarter. The markets do not like such cautious statements, especially from the company's management. After the statement, the markets reacted to it, and as we can see from the TCS's spot market quote, the stock went down by over 3.6%. In the snapshot below, the price per share is highlighted in blue. Ignore the red highlight. We will discuss about it shortly. I, as trader, believe that the TCS stock price reaction to the management's statement is a bit exaggerated. Here is my rationale. If you follow TCS or any Indian IT sector company in general, you will know that December is usually a lackluster month for the Indian IT companies. December is the financial year end in the US, the biggest market for the Indian IT companies, and also the holiday season. Hence the business moves quite slowly for such companies. This furlough has a significant impact on the IT sector revenues. This information is already known and factored in by the market. Hence, I believe the stock sinking by 3.6% is unwarranted. I also feel this could be an opportunity to buy TCS, as I believe the stock price will eventually go up. Hence I would be a buyer in TCS after such an announcement. Notice, based on my thoughts, which I perceive as rational, I have developed a directional view on the price of the asset TCS. From my analysis, I believe the TCS underlying asset stock price will increase in due course of time. In other words, I am bullish about TCS at the current market price. Now, instead of buying TCS shares in the spot market, I decide to buy the TCS futures for reasons I will discuss in the next chapter. Having decided to buy futures, all I need to see is price at which the TCS futures is trading at. The contract details are readily available on the NSE's website. In fact, the link to get details for a TCS futures contract is available on the spot market quote. I have highlighted the same in red in the image above. Recall, the futures price should always mimic the spot price, meaning if the spot price has gone down, the futures price should also go down. Here is a snapshot from NSE's website showing the TCS futures price. As expected, the futures price has mimicked the spot price and therefore the TCS futures is also down by 3.77%. You may have two questions at this point. TCS in the spot market is down by 3.61%. However, TCS futures is down by 3.77%. Why the difference? TCS spot price is at 2,362 rupees and 35 paise. But futures price is at 2,374 rupees and 90 paise. Why the difference? Both these are valid questions at this point, and the answer to these questions depends upon the futures pricing formula. a topic we will deal with at a later point in time. But the most important point to note at this stage is that the futures price has moved in line with the spot price, and both of them are down for the day. Now, before we proceed any further, let us relook at the futures contract and inspect a few key elements. Allow me to repost the futures contract with a few important features highlighted. Starting from top, the box highlighted in red has 3 important bits of information. Instrument type. Remember, the underlying asset is the stock of a company and we are interested in the asset's future contract. Hence, the instrument type here is the stock futures. Symbol. This highlights the name of the stock. TCS in this case. Expiry date. This is the date on which the contract ceases to exist. As we can see, the TCS futures contract specifies the 24th of December 2014 as the expiry. You may be interested to know that all derivative contracts in India expire on the last Thursday of the month. We will discuss more on what happens on the expiry date at a later point. We had looked at the blue box a little earlier. It just highlights the future price. Lastly, the black box highlights 2 important parameters, the underlying value and the market lot. Underlying value. This is the same as the price at which the underlying is trading in the spot market. From the earlier snapshot, we know TCS was trading at 2,362 rupees and 35 paise per share. However, when I took the above snapshot, TCS fell by another few points. Hence the price we see here is 2,359 rupees and 95 paise per share. Market lot. Lot size. Remember, a futures contract is a standardized contract. The parameters are prefixed. Lot size is the minimum number of shares that we need to buy, sell if we wish to enter into an agreement. The lot size for the TCS futures is 125. Which means a minimum of 125 shares or a multiple of 125 shares have to be transacted while trading the TCS futures. Recall, in the previous chapter we had discussed about the contract value, which is simply lot size multiplied by the futures price. We can now calculate the contract value for TCS futures as follows. Contract value equals lot size x price of futures equals 125 x 2,374 rupees and 90 paise equals Rs 296,862.5. Now before we proceed to discuss about the TCS futures trade, let us quickly look at another futures contract just to rivet our understanding so far. Here is the snapshot of the futures contract of State Bank of India, SBI. With the help of the above snapshot, you can perhaps answer the following questions. What is the instrument type? What is SBI's futures price? How does SBI's future price compare with its spot price? What is the expiry date of the futures contract? What is the lot size and the contract value of SBI futures? 3.2 The futures trade. Now going back to the TCS futures trade. The idea is to buy a futures contract as I expect the TCS stock price to go up. The price at which I would buy TCS futures is 2,374 rupees and 90 paise per share. Remember, the minimum number of shares that I need to buy is 125. The minimum number of shares is also colloquially called one lot. So how do we buy the futures contract? Well, this is quite simple. We can call our broker and ask him to buy one lot of TCS futures at 2,374 rupees and 90 paise per. Or we can buy it ourselves through the broker's trading terminal. I prefer to place trades myself through the trading terminal. If you are new to the trading terminal, I would suggest you read through the chapter on the trading terminal. Once TCS futures is loaded on my market watch, all I need to do is just press F1 and buy the contract. The moment I press the F1 key, expressing my interest to buy TCS futures on my trading terminal, a couple of things happen in the background. Margin validation. Remember, whenever we enter into a futures agreement, we need to deposit a margin amount, sort of a token advance, which is simply a percentage of the contract value. We will discuss margins shortly. If there is insufficient margin, we cannot enter into the agreement. So as the first step, the broker's risk management system software checks if I have sufficient money in my trading account to suffice the margin requirement to enter into a futures agreement. The counterparty search after validating the margins. The system scouts for a relevant counterparty match. The match has to be made between me, the buyer of the TCS futures, and the seller of the TCS futures. Remember, the stock exchange is a financial supermarket where one can find many participants with different views on the price of an asset. The seller of TCS futures obviously thinks TCS futures price will go further down. Just like my rationale as to why the TCS stock price will go higher, the seller has his own rationale for his directional view. Hence he wants to be a seller. The sign-off 1 step 1 and 2 are through, i.e., the margin validation and finding the counterparty. The buyer and the seller digitally sign the futures agreement. This is mainly a symbolic process. By agreeing to buy or sell the futures agreement, one gives consent to the other to honor the contract specifications. The margin block after the sign-off is done. The required margin is blocked in our trading account. We cannot use the blocked margin for any other purpose. The money will be blocked as long as we hold the futures contract. With the completion of these 4 steps, I now own 1 lot of TCS futures contract. You may be surprised to know, in the real markets, all the above-mentioned steps happen sequentially in a matter of a few seconds. Here is a critical question. What does it mean by, I now own 1 lot of TCS futures contract? Well, it simply means by purchasing TCS futures on the 15th of December 2014, I have digitally entered into an agreement with a certain counterparty agreeing to buy 125 TCS shares from me, counterparty, at 2,374 rupees and 90 paise per share. This futures agreement between me and the counterparty expires on the 24th of December 2014. 3.3 The 3 possible scenarios post the agreement. After entering into the agreement, there are 3 possible scenarios that can pan out by the 24th of December 2014. We know what these scenarios are. We studied them in Chapter 1. The price of TCS can go up. The price of TCS can come down. Or the price of TCS could stay the same. Let us just arbitrarily take a few possible price situations and see what would be the impact of the price on both the parties involved. Scenario 1. TCS stock price goes up by the 24th of December. This is a case where my directional view on TCS shares has come true. Therefore I stand to benefit. Assume on the 24th of December 2014, the stock price of TCS has gone up from 2,374 rupees and 90 paise per to 2,450 rupees per share. By virtue of the increase in spot price, the futures price would also increase. This means, as per the agreement, I am entitled to buy the TCS shares at 2,374 rupees and 90 paise per share, which is a much lower price compared to what is available in the market. My profit will be 75 rupees and 10 paise per share, 2,450 rupees, 2,374 rupees and 90 paise. Since the deal is for 125 shares, my overall profit will be 9,387 rupees and 50 paise per, 75 rupees and 10 paise per asterisk 125. The seller obviously incurs a loss, as he is forced to sell TCS shares at 2,374 rupees and 90 paise per share as opposed to selling it in the open market at a much higher price of 2,450 rupees per share. Clearly, the buyer's gain is the seller loss. Scenario 2. TCS stock price goes down by the 24th of December. This is a case where my directional view on TCS shares has gone wrong. Therefore I would stand to lose. Assume on the 24th of December 2014, the stock price of TCS goes down from 2,374 rupees and 90 paise per to 2,300 rupees per share. By virtue of this decrease, the futures price will also be around the same level. This means, as per the agreement, I am obligated to buy the TCS shares at 2,374 rupees and 90 paise per share, which is a much higher price compared to what is available in the market. My loss will be 75 rupees per share, 2,374 rupees and 90 paise, 2,300 rupees. Since the deal is for 125 shares, my overall loss will be 9,375 rupees per 75 rupees per asterisk 125. I would obviously incur a loss as I'm forced to buy the TCS shares at 2,374 rupees and 90 paise per share as opposed to buying it in the open market at a much lower price of 2,300 rupees per share. Clearly, the seller's gain is the buyer's loss. Scenario 3: TCS stock price remains unchanged. Under such a situation, neither the buyer nor the seller benefit. Hence, there is no financial impact on either party. 3.3 Exploiting a trading opportunity. So here is the situation. After buying the TCS futures on the 15th of December 2014 at 2,374 rupees and 90 paise per the very next day, i.e. the 16th of December 2014, TCS price shot up. It is now trading at 2,460 rupees per. What do I do? Clearly, with the price increase, I stand to benefit significantly. To be precise, at the time of taking the snapshot, I am sitting at a profit of 85 rupees and 10 paise per share, or 10,637 rupees and 50 paise per 85 rupees and 10 paise per asterisk 125 as an overall profit. Suppose I am happy with the money that I have made overnight. Can I close out the agreement? Or rather at 2,460 rupees per share? What if my view changes? What if I no longer feel bullish about TCS at 2,460 rupees? Do I really need to hold on to the agreement until the contract expiry date, i.e. the 24th of December 2014? By which time, if the price goes down, it could lead to a loss. Well, as I had mentioned in the previous chapter, the futures agreement is tradable. Meaning, at any point after entering into a futures agreement, I can easily get out of the agreement by transferring the agreement to someone else. This means I can close the existing TCS futures position and book a profit of 10,637 rupees and 50 paise per. Not bad for a one-day job, right? J. Closing an existing futures position is called square off. By squaring off, I offset an existing open position. In case of the TCS example, initially I bought one lot of TCS futures, and when I square off, I have to sell one lot of TCS futures, so that my initial buy position is offset. The following table summarizes the concept of square off in general. Serial no initial leg view at the time of initial leg, square off leg view at the time of squaring off. 01 Buy, long expect price to go higher, bullish sell, no longer expect the price to go higher, or one just wants to get out of the existing position for whatever reason. 02 Sell, short expect price to go lower, bearish buy, no longer expect the price to go lower, or one just wants to get out of the existing position for whatever reason. When I intend to square off a position, I can either call my broker asking him to square off the open position, or I can do it myself on the trading terminal. In the example, we have a buy open position in TCS futures, one lot. To offset this open position, the square off position would be to sell one lot of TCS futures. The following things happen when I opt to square off the TCS position. The broker, via trading terminal, scouts for a counterparty that would be willing to buy the futures position from me. In simpler words, my existing buy position will simply be transferred to someone else. That someone else, by virtue of buying the contract from me, now bears the risk of the TCS price going up or down. Hence, this is simply referred to as the risk transfer. Note: the transfer will happen at the current futures price in the market, i.e. 2,460 per share. My position is considered offset or squared off after the trade is executed. Once the trade is executed, the margins that were initially blocked would now be unblocked. I can utilize this cash for other transactions. The profit or loss made on the transaction will be credited or debited to my trading account the same evening itself. And with this, the futures trade is now set to be complete. Note: if at 2,460 rupees I develop a view that the price is going to be much higher, I could continue to hold the stock futures. In fact, I can continue to hold the futures till the contract's expiry, i.e. the 24th of December 2014. As long as I continue to hold the futures, I continue to hold the risk of TCS price fluctuation. In fact, here is the snapshot of TCS futures taken on the 23rd of December 2014, just one day before the expiry of the contract. Had I opted to hold the futures till the 23rd of December, my profits would have been much higher. TCS futures is trading at 2,519 rupees and 25 paise per share. In fact, on the 16th of December 2014, when I decided to book profits at 2,460 rupees per, someone else bought the TCS futures from me. In other words, I transferred my buy position to someone else. And even that someone else, the counterparty, would also have made money on this contract by buying the contract at 2,460 rupees per from me and holding it until the 23rd of December 2014. Now here are two simple questions for you. What would be my profit and loss P&L on a per share and on an overall basis had I held the TCS futures from the 15th of December 2014, 2,374 rupees and 90 paise to the 23rd of December 2015, 2,519 rupees and 25 paise. On the 16th of December 2014, I squared off my position at 2,460 rupees per. Obviously, by virtue of the square off, the contract was transferred to a counterparty. Assuming the counterparty held on to the TCS futures position until the 23rd of December 2014. What would be his profit and loss P&L on a per share basis and on an overall basis? If you are unable to answer the above two questions, you can drop in a query in the comment box below and I will be happy to explain the answer. But I sincerely hope you get the answers to the questions above yourself slightly smiling face. In the next chapter we will discuss about margins, a very important aspect of futures trading. Key takeaways from this chapter. If you have a directional view on an asset's price, you can financially benefit from it by entering into a futures agreement. To transact in a futures contract, one needs to deposit a token advance called the margin. When we transact in a futures contract, we digitally sign the agreement with the counterparty. This obligates us to honor the contract. The futures price and the spot price of an asset are different. This is attributable to the futures pricing formula. We will discuss this topic later. One lot refers to the minimum number of shares that needs to be transacted. Once we enter into a futures agreement, there is no obligation to stick to the agreement until the contract expires. Every futures trade requires a margin amount. The margins are blocked the moment you enter a futures trade. We can exit the agreement anytime, which means you can exit the agreement within seconds of entering the agreement. When we square off an agreement, we are essentially transferring the risk to someone else. Once we square off the futures position, margins are unblocked. The money that you make or lose in a futures transaction is credited or debited to your trading account the same day. In a futures contract, the buyer's gain is the seller's loss and vice versa. 221 responses to the futures trade. Deepak Patil. Open a ZERODHA account. Chapter 4. Leverage and Payoff. 4.1a Quick Recap. With the help of the Tata Consultancy Services (TCS) example in the previous chapter, we got a working knowledge on how futures trading works. The futures trade example required us to go long on TCS futures as the expectation was that the TCS stock price would increase in due course. Further, we decided to square off the contract the very next day for a profit. However, if you recall, right at the beginning of the example we posed a very important question. Let me rephrase and repost the same for your ready reference. The rationale to go long on TCS was built. The thought was that TCS stock price had overreacted to the management statement. I expected the stock price to increase in due course of time. A directional view was established and hence a futures trade was initiated. Now, the question was, anyway, the expectation is that the stock price will go higher. Why should one bother about buying futures and why not the stock in spot market? In fact, buying futures requires one to enter a digital agreement with the counterparty. Besides, a futures agreement is time-bound, meaning the directional view has to pan out within the specified time period. If it does not pan out within the specified time, as in the expiry, then one has to suffer a loss. Contrast this futures buying with just buying stock and letting it reside in your Demot account. There is no obligation of an agreement or the pressure of time. So why does one really need futures? What makes it so attractive? Why not just buy the stock and stay oblivious to the stock price and the time? The answers to all these questions lie in the financial leverage which is inherent in financial derivatives, including futures. Leverage, as they say, is a true financial innovation. If used in the right context and spirit, leverage can create wealth. Without much ado, let us explore this angle of futures trading. 4.2 Leverage in perspective. Leverage is something we use at some point or the other in our lives. It is just that we don't think about it in the way it is supposed to be thought about. We miss seeing through the numbers and therefore never really appreciate the essence of leverage. Here is a classic example of leverage. Many of you may relate to this one. A friend of mine is a real estate trader. He likes to buy apartments, sites, and buildings, holds them for a while and then sells them for a profit at a later stage. He believes this is better than trading in equities. I beg to differ. I could go on and on debating this, but maybe some other time. Anyway, here is a summary of a recent real estate transaction he carried out. In November 2013, Prestige Builders, popular builders in Bangalore, identified a piece of land in South Bangalore and announced a new project, a luxurious apartment complex with state-of-the-art amenities. My friend jumped in and booked a 2-bedroom, hall, and kitchen apartment, expected to come up on the 9th floor for a sum of 10 million rupees per. The project is expected to be completed by mid-2018. Since the apartment was just notified and no work had started, the potential buyers were only required to pay 10% of the actual buy value. This is pretty much the norm when it comes to buying brand new apartments. The remaining 90% was scheduled to be paid as the construction progressed. So back in November 2013, for an initial cash outlay of 10 rupees, 10% of 10 million, my friend was entitled to buy a property worth 10 million rupees per. In fact, the property was so hot, all the 120 apartments were sold out like hotcakes just within 2 months of Prestige Builder announcing the brand new project. Fast forward to December 2014. My friend had a potential buyer for his apartment. Being a real estate trader, my friend jumped into the opportunity. A quick survey revealed that the property value in the area had appreciated by at least 25%. Well, that's how crazy real estate is in Bangalore. So my friend's 9th floor apartment was now valued at 12,500,000 rupees per. My friend and the potential buyer struck a deal and settled on the sale at 12,500,000 rupees per. Here is a table summarizing the transaction. Particulars details. Initial value of apartment Rs. 10 million. Date of purchase November 2013. Initial cash outlay at 10% of apartment value 10 rupees. Balance payment to builder 90 rupees. Appreciation in apartment value 25%. Value of the apartment in December 2014 12,500,000 rupees per. New buyer agrees to pay the balance payment 90 rupees to the builder. My friend gets paid 12,500,000 9 million equals 35 rupees My friend's profit on the transaction 35 rupees minus 10 rupees equals 25 rupees Return on investment 25 10 equals 250%. Clearly, few things stand out in this transaction. My friend was able to participate in a large transaction by paying only 10% of the transaction value to enter into the transaction. My friend had to pay 10% of the actual value, call it the contract value. The initial value he pays, 10 lakhs, can be considered as a token advance, or in terms of futures agreement, it would be the initial margin deposit. A small change in the asset value impacts the return massively. This is quite obvious. A 25% increase in asset value resulted in a 250% return on investment. A transaction of this type is called a leveraged transaction. Do make sure you understand this example thoroughly, because this is very similar to a futures trade, as all futures transactions are leveraged. Do keep this example in perspective, as we will now move back to the TCS trade. 4.3 The leverage. While we looked at the overall structure of the futures trade in the previous chapter, let us now rework on the TCS example with some specific details. The trade details are as follows. For the sake of simplicity, we will assume the opportunity to buy TCS occurs on 15th of Dec at 2,362 rupees per share. Further, we will assume the opportunity to square off this position occurs on the 23rd of December 2014 at 2,519 rupees per. Also, we will assume there is no difference between the spot and future price. Particulars details. Underlying TCS Limited. Directional view bullish. Action buy. Capital available for the trade 100,000 rupees per. Trade type short term. Remarks: the expectation is that the stock price will increase over the next few days. Buy date the 15th of December 2014. Approximate buy price 2,362 rupees per share. Sell date the 23rd of December 2014. Approximate sell price 2,519 rupees per share. So with a bullish view on TCS stock price and 100,000 rupees per in hand, we have to decide between the two options at our disposal. Option 1, buy TCS stock in the spot market, or option 2, buy TCS futures from the derivatives market. Let us evaluate each option to understand the respective dynamics. Option 1, buy TCS stock in spot market. Buying TCS in spot market requires us to check for the price at which the stock is trading. Calculate the number of stocks we can afford to buy with the capital at our disposal. After buying the stock in the spot market, we have to wait for at least 2 working days, T+2, for the stock to get credited to our Demat account. Once the stocks resides in the Demat account, we just have to wait for the right opportunity to sell the stocks. Few salient features of buying the stock in the spot market. Delivery-based buying. Once we buy the stock for delivery to Demat, we have to wait for at least 2 working days before we can decide to sell it. This means even if the very next day, if a good opportunity to sell comes up, we cannot really sell the stock. We can buy the stock to the extent of the capital at our disposal. Meaning, if our disposable cash is 100,000 rupees per, we can only buy to the extent of 100,000 rupees per, not beyond this. There is no pressure of time. As long as one has the time and patience, one can wait for really long time before deciding to sell. Specifically with 100,000 rupees per at our disposal. On the 15th of December 2014, we can buy equals 100,000 2,360 seconds. Approximately 42 shares. Now, on the 23rd of December 2014, when TCS is trading at 2,519 rupees per, we can square off the position for a profit equals 42 asterisk 2,519 equals 105,798 rupees per. So 100,000 rupees per invested in TCS on the 14th of December 2014 has now turned into 105,798 rupees per on the 23rd of December 2014, generating 5,798 rupees per in profits. Interesting. Let us check the return generated by this trade. Equals 5,798 100,000 asterisk 100 equals 5.79%. A 5.79% return over 9 days is quite impressive. In fact, a 9-day return of 5.79% when annualized yields about 235%. This is phenomenal. But how does this contrast with option 2? Option 2: buy TCS stock in the futures market. Recall, in futures market variables are predetermined. For instance, the minimum number of shares, lot size, that needs to be bought in TCS is 125 or n. Multiples of 125. The lot size multiplied by the futures price gives us the contract value. We know the futures price is 2,362 rupees per share. Hence the contract value is equals 125 asterisk 2,362 equals 295,250 rupees per. Now, does that mean to participate in the futures market I need 295,250 rupees per in total cash? Not really. 295,250 rupees per is the contract value. However, to participate in the futures market one just needs to deposit a margin amount which is a certain percent of the contract value. In case of TCS futures, we need about 14% margin. At 14% margin, 14% of 295,250 rupees per 41,335 rupees per is all we need to enter into a futures agreement. At this stage, you may get the following questions in your mind. What about the balance money? I.e. 253,915 rupees per 295,250 rupees per minus 41,335 rupees per. Well, that money is never really paid out. What do I mean by never really paid out? We will understand this in greater clarity when we take up the chapter on settlement, Mark Chapter 2. Markets. Is 14% fixed for all stocks? No. It varies from stock to stock. So, keeping these few points in perspective, let us explore the futures trade further. The cash available in hand is 100,000 rupees per. However, the cash requirement in terms of margin amount is just Rs. 41,335 rupees per. This means instead of one lot, maybe we can buy 2 lots of TCS futures. With 2 lots of TCS futures, the number of shares would be 250, 125 asterisk 2 at the cost of 82,670 rupees per as margin requirement. After committing 82,670 rupees per as margin amount for 2 lots, we would still be left with 17,330 rupees per in cash. But we cannot really do anything with this money, hence it is best left untouched. Now here is how the TCS futures equation stacks up. Lot size 125. Know it lots 2. Futures by price Rs. 2,362. Futures contract value at the time of buying equals lot size number of lots futures by price equals 125 asterisk 2 asterisk Rs. 2,362 equals Rs. 590,500. Margin amount 82,670 rupees per. Futures sell price equals 2,519 rupees per. Futures contract value at the time of selling equals 125 asterisk 2 asterisk 2,519 equals 629,750 rupees per. This translates to a profit of Rs. 39,250. Can you see the difference? A move from 2,361 to 2,519 generated a profit of 5,798 rupees per in spot market. But the same move generated a profit of Rs. 39,250. Let us see how juicy this looks in terms of percent return. Remember, our investment for the futures trade is 82,670 rupees per. Hence the return has to be calculated keeping this as the base. 39,250 82,670 asterisk 100. Well, this translates to a whopping 47% over 9 days. Contrast that with 5.79% in the spot market. For sake of annualizing, this translates to an annual return of 1,925%. And with this, hopefully I should have convinced you why short-term traders prefer transactions in futures market as opposed to spot market transactions. Futures offer something more than a plain vanilla spot market transaction. Thanks to the existence of margins, you require a much lesser amount to enter into a relatively large transaction. If your directional view is right, your profits can be really large. By virtue of margins, we can take positions much bigger than the capital available. This is called leverage. Leverage is a double-edged sword. If used in the right spirit and knowledge, leverage can create wealth. If not, it can destroy wealth. Before we proceed further, let us just summarize the contrast between the spot and futures market in the following table. Particular spot market futures markets. Capital available 100,000 rupees per 100,000 rupees per. Buy date the 15th of December 2014, 15th December 2014. Buy price 2,362 rupees per share, 2,362 rupees per share. QTY 100,000 2,360 seconds equals 42 shares depends on lot size. Lot size not applicable 125. Margin not applicable 14%. Contract value per lot not applicable 125 asterisk 2,362 equals 295,250. Margin deposit per lot not applicable 14% asterisk 295,250 equals 41,335. How many lots can be bought not applicable 100,000 41,335 equals 2.4 or 2 lots. Margin deposit not applicable 41,335 asterisk 2 equals 82,670. Know if shares bought 42 as calculated above 125 asterisk 2 equals 250. Buy value, contract value 42 asterisk 2,362 equals 100,000 2 asterisk 125 asterisk 2,362 equals 590,500. Sell date the 23rd of December 2014, 23rd December 2014. No of days trade was live 9 days. Sell price 2,519 rupees per share, 2,519 rupees per share. Sell value 42 asterisk 2,519 equals 105,798 250 asterisk 2,519 equals 629,750. Profit earned 105,798,100,000 equals 5,798 rupees per 629,750 590,500 equals 39,250 rupees per. Absolute return for 9 days 5,798 100,000 equals 5.79% 39,250 82,670 equals 47%. Percent return annualized 235% 1,925%. All through we have discussed about rewards of transacting in futures. But what about the risk involved? What if the directional view does not pan out as expected? To understand both the sides of futures trade, we need to understand how much money we stand to make or lose based on the movement in the underlying. This is called the futures payoff. 4.4 Leverage calculation. Usually when we talk about leverage, the common questions one gets asked is, how many times leverage are you exposed to? The higher the leverage, higher is the risk, and the higher is the profit potential. Calculating leverage is quite easy. Leverage equals contract value margin. Hence for TCS trade the leverage is equals 295,250 41,335 equals 7.14, which is read as 7.14 times or simply as a ratio 1. 7.14. This means every 1 rupee per in the trading account can buy up to 7 rupees and 14 paise per worth of TCS. This is a very manageable ratio. However, if the leverage increases, then the risk also increases. Allow me to explain. At 7.14 times leverage, TCS has to fall by 14% for 1 to lose all the margin amount. This can be calculated as 1. Leverage equals 1/7.14 equals 14%. Now for a moment assume the margin requirement was just 7,000 rupees per instead of 41,335 rupees per. In this case, the leverage would be equals 295,257 thousandths equals 42.17 times. This is clearly a very high leverage ratio. One would lose all his capital if TCS falls by 141.17 equals 2.3%. So, the higher the leverage, the higher is the risk. When leverage is high, only a small move in the underlying is required to wipe out the margin deposit. Alternatively, at roughly 42 times leverage, you just need a 2.3% move in the underlying to double your money. Smiley face. I personally don't like to over-leverage. I stick to trades where the leverage is about 110 or about 112. Not beyond this. 4.5 The futures payoff. Imagine this: when I bought TCS futures, the expectation was that TCS stock price would go higher, and therefore I would financially benefit from the futures transaction. But what if instead of going up, TCS stock price went down? I would obviously make a loss. Think about it. After initiating a futures trade, at every price point I would either stand to make a profit or loss. The payoff structure of a futures transaction simply highlights the extent to which I either make a profit or loss at various possible price points. To understand the payoff structure better, let us build one for the TCS trade. Remember, it is a long trade initiated at 2,362 rupees per on 16th of Dec. After initiating the trade, by the 23rd of December, the price of TCS can go anywhere. Like I mentioned, at every price point I will either make a profit or a loss. Hence, while building the payoff structure, I will assume various possible price point situations that can pan out by the 23rd of December. And I will analyze the P&L situation at each of these possibilities. In fact, the table below does the same. Possible price on the 23rd of December, buyer P&L price on the 23rd of December, buy price 2,160, 202, 2,180, 182, 2,200, 162, 2,220, 142, 2,240, 122, 2,260, 102, 2,280, 82, 2,362, 2,320, 42, 2,340, 22, 2,360, 2, 2,380, 18, 2,438, 2,420, 58, 2,440, 78, 2,460, 98, 2,480, 118, 2,500, 138, 2,520, 158, 2,540, 178, 2,560, 198, 2,580, 218, 2,600, 238. This is the way you need to read this table, considering you are a buyer at 2,362 rupees per. What would be the P&L by the 23rd of December, assuming TCS's trading is 2,160 rupees per? As the table suggests, you would make a loss of 202 rupees per share, 2362, 2160. Likewise, what would be your P&L if TCS is trading at 2,600? Well, as the table suggests, you would make a profit of 238 rupees per share, 2600, 2362, so on and so forth. In fact, if you recollect from the previous chapter, we stated that if the buyer is making Rs X as profit, then the seller is suffering a loss to the extent of Rs X. So assuming the 23rd of December TCS is trading at 2,600, The buyer makes a profit of 238 rupees per share and the seller would be making a loss of 238 rupees per share, provided that the seller has shorted the share of 2,362 rupees per. Another way to look at this is that the money is being transferred from the seller's pocket to the buyer's pocket. It is just a transfer of money and not creation of money. There is a difference between the transfer of money and creation of money. Money is generated when value is created. For example, you have bought TCS shares from a long-term perspective. TCS as a business as well. Profits and margins improve, then obviously you as a shareholder will benefit by virtue of appreciation in share price. This is money creation or wealth generation. If you contrast this with futures, money is not being created but rather moving from one pocket to another. Precisely for this reasons futures, rather financial derivatives in general, is called a zero-sum game. Further, let us now plot a graph of the possible price on the 23rd of December versus the buyer's P&L. This is also called the payoff structure. As you can see, any price above the buy price 2,362 results in a profit and any price below the buy price results in a loss. Since the trade involved purchasing 2 lots of futures, 250 shares, a 1-point positive movement from 2,362 to 2,363 results in a gain of 250 rupees. Likewise, a 1-point negative movement from 2,362 to 2,361 results in a loss of 250 rupees. Clearly, there is a sense of proportionality here. The proportionality comes from the fact that the money made by the buyer is the loss suffered by the seller, provided they have bought short the same price, and vice versa. Most importantly, because the P&L is a smooth straight line, it is said that the futures is a linear payoff instrument. Key takeaways from this chapter. Leverage plays a key role in futures trading. Margins allow us to deposit a small amount of money and take exposure to a large value transaction. Margins charged is usually a % of the contract value. Spot market transactions are not leveraged. We can transact to the extent of the capital that we have. By virtue of leverage, a small change in the underlying results in a massive impact on the P&L. The profits made by the buyer is equivalent to the loss made by the seller and vice versa. The higher the leverage, the higher is the risk and therefore the higher the chance of making money. Futures instrument simply allows one to transfer money from one pocket to another. Hence it is called a zero-sum game. The payoff structure of a futures instrument is linear. 112. Open a ZERODHA account. Chapter 5. Margin and M2M. 5.1 Things you should know by now. Margins clearly play a very crucial role in futures trading as it enables one to leverage. In fact, margins are the one that gives a futures agreement the required financial twist as compared to the spot market transaction. For this reason, understanding the margins and many facets of margins is extremely important. However, before we proceed any further, let us list down a list of things you should know by now. These are concepts we had learned over the last 4 chapters. Reiterating these crucial takeaways will help us consolidate all the learning. At this, if you are not clear about any of the following points, you will need to revisit the previous chapters and refresh your understanding. Futures is an improvisation over the forwards. The futures agreement inherits the transactional structure of the forwards market. A futures agreement enables you to financially benefit if you have an accurate directional view on the asset price. The futures agreement derives its value from its corresponding underlying in the spot market. For example, TCS futures derives its value from the underlying in the TCS spot market. The futures price mimics the underlying price in the spot market. The futures price and the spot price of an asset are different. This is attributable to the futures pricing formula. We will discuss this point at a later stage in the module. The futures contract is a standardized contract wherein the variables of the agreement is predetermined lot size and expiry date. Lot size is the minimum quantity specified in the futures contract. Contract value equals futures price asterisk lot size. Expiry is the last date up to which one can hold the futures agreement. To enter into a futures agreement, one has to deposit a margin amount, which is calculated as a certain percent of the contract value. Margins allow us to deposit a small amount of money and take exposure to a large value transaction, thereby leveraging on the transaction. When we transact in a futures contract, we digitally sign the agreement with the counterparty. This obligates us to honor the contract upon expiry. The futures agreement is tradable, which means you need not hold on to the agreement till the expiry. You can hold the futures contract till you have a conviction on the directional view on the asset. Once your view changes, you can get out of the futures agreement. You can even hold the futures agreement for a few minutes and financially benefit if the price moves in your favor. An example of the above point would be to buy Infosys futures at 9:15 a.m. at a price of $19.51 and sell it by 9:17 a.m. at $19.53. Since Infosys lot size is 250, one would stand to make 500 rupees per 2*250 within a matter of 2 minutes. You can even choose to hold it overnight for a few days or hold on to it till expiry. Equity futures contracts are cash settled. By virtue of leverage, a small change in the underlying results in a massive impact on the P&L. The profits made by the buyer is equivalent to the loss made by the seller and vice versa. Futures instrument allows one to transfer money from one pocket to another. Hence it is called a zero-sum game. The higher the leverage, the higher the risk. The payoff structure of a futures instrument is linear. The futures market is regulated by Securities and Exchange Board of India, SEBI. Thanks to the watchful eye of SEBI, there have been no incidents of counterparty default in the futures market. If you can clearly understand the points mentioned above, then I'd assume you are on the right track so far. If you have any questions on any of the above mentioned points, then you need to revisit the previous 4 chapters to get the concept right. Anyway, assuming you are clear so far, let us now focus more on concept of margins and mark-to-market. 5.2 Why are margins charged? Let us now rewind back to the example we quoted in the Forwards Market, Chapter 1. In the example quoted, 3 months from now, ABC Jewelers agrees to buy 15 kgs of gold at 2,450 rupees per gram from XYZ gold dealers. We can now clearly appreciate that any variation in the price of gold will either affect ABC or XYZ negatively. If the price of gold increases, then XYZ suffers a loss and ABC makes a profit. Likewise, if the price of gold decreases, ABC suffers a loss and XYZ makes a profit. Also, we know that a forwards agreement works on a gentleman's word. Consider a situation where the price of gold has drastically gone up, placing XYZ gold dealers in a difficult spot. Clearly, XYZ can say they cannot make the necessary payment and thereby default on the deal. Obviously, what follows will be a long and grueling legal chase. But that is outside our focus area. The point to be noted here is that in a forwards agreement, the scope and the incentive to default is very high. Since futures market is an improvisation over the forwards market, the angle of default is carefully and intelligently dealt with. This is where the margins play a role. In the forwards market, there is no regulator. The agreement takes place between two parties with literally no intermediary watching over their transaction. However, in the futures market, all trades are routed through an exchange. The exchange in return takes the onus of guaranteeing the settlement of all the trades. When I say onus of guaranteeing, it literally means the exchange makes sure you get your money if you are entitled. This also means they ensure they collect the money from the party who is supposed to pay up. So how does the exchange make sure this works seamlessly? Well, they make this happen by means of collecting the margins, marking the daily profits or losses to market, also called M2M. We briefly looked into the concept of margin in the previous chapter. The concept of margin and M2M is something that you need to know in parallel to fully appreciate the dynamics of futures trading. However, since it is difficult to explain both the concepts at the same time, I would like to pause a bit on margins and proceed to M2M. We will understand M2M completely and come back again to margins. We will then relook at margins, keeping M2M in perspective. But before we move to M2M, I would like you to keep the following points in the back of your mind. At the time of initiating the futures position, margins are blocked in your trading account. The margins that get blocked is also called the initial margin. The initial margin is made up of two components, i.e., span margin and the exposure margin. Initial margin equals span margin plus exposure margin. Initial margin will be blocked in your trading account for how many ever days you choose to hold the futures trade. The value of initial margin varies daily as it depends on the futures price. Remember, initial margin equals percent of contract value. Contract value equals futures price asterisk lot size. Lot size is a fixed, but the futures price varies every day. This means the margins also vary every day. So for now, remember just these points. We will go ahead to understand M2M and then we will come back to margins to complete this chapter. 5.3 Mark-to-market M2M. As we know, the futures price fluctuates on a daily basis, by virtue of which you either stand to make a profit or a loss. Marking-to-market, or mark-to-market M2M, is a simple accounting procedure which involves adjusting the profit or loss you have made for the day and entitling you the same. As long as you hold the futures contract, M2M is applicable. Let us take up a simple example to understand this. Assume on the 1st of December 2014 at around 11:30 a.m. you decide to buy Hindalco futures at 165 rupees per. The lot size is 2,000. 4 days later, on the 4th of December 2014, you decide to square off the position at 2:15 p.m. at 170 rupees and 10 paise per. Clearly, as the calculation below shows, this is a profitable trade. Buy price equals 165 rupees. Sell price equals 170 rupees and 10 paise. Profit per share equals 170.1 to 165 equals 5 rupees and 10 paise per. Total profit equals 2,000 asterisk 5.1 equals 10,200 rupees per. However, the trade was held for 4 working days. Each day the futures contract is held. The profits or losses marked to market. While marking to market, the previous day closing price is taken as the reference rate to calculate the profit or losses. Day closing price. The 1st of December 2014, 168.3. The 2nd of December 2014, 172.4. The 3rd of December 2014, 171.6. The 4th of December 2014, 169.9. The table above shows the futures price movement over the 4 days the contract was held. Let us look at what happens on a day-to-day basis to understand how M2M works. On day 1 at 11:30 a.m. the futures contract was purchased at 165 rupees per. Clearly, after the contract was purchased, the price has gone up further to close at 168 rupees and 30 paise per. Hence, profit for the day is 168.3 minus 165 equals 3 rupees and 30 paise per share. Since the lot size is 2,000, the net profit for the day is 3.3 asterisk 2,000 equals 6,600 rupees per. Hence, the exchange ensures via the broker that 6,600 rupees per is credited to your trading account at the end of the day. But where is this money coming from? Obviously, it is coming from the counterparty, which means the exchange is also ensuring that the counterparty is paying up 6,600 rupees per towards his loss. But how does the exchange ensure they get this money from the party who is supposed to pay up? Obviously through the margins that are deposited at the time of initiating the trade. But more on this later. Now here is another important aspect you need to note from an accounting perspective. The futures buy price is no longer treated as 165 rupees, but instead it will be considered as 168 rupees and 30 paise per closing price of the day. Why is that so, you may ask? Well, the profit that was earned for the day has been given to you already by means of crediting the trading account. So you are fair and square for the day. And the next day is considered a fresh start. Hence the buy price is now considered at Rs. 168.3. which is the closing price of the day. On day 2, the futures closed at 172 rupees and 40 paise per. Clearly another day of profit. The profit earned for the day would be 172 rupees and 40 paise per minus 168 rupees and 30 paise per, i.e. 4 rupees and 10 paise per share, or 8,200 rupees per net profit. The profits that you are entitled to receive is credited to your trading account, and the buy price is reset to the day's closing price, i.e. 172.4. On day 3, the futures closed at 171 rupees and 60 paise per, which means with respect to the previous day's close price there is a loss to the extent of 1,600 rupees per 172.4 to 171.6 * 2000. The loss amount will be automatically debited from your trading account. Also, the buy price is now reset to 171 rupees and 60 paise per. On day 4, the trader did not continue to hold the position through the day, but rather decided to square off the position midday 2:15 p.m. at 170 rupees and 10 paise per. Hence, with respect to the previous day's close, he again made a loss. That would be a loss of 171 rupees and 60 paise per minus 170 rupees and 10 paise per equals 1 rupee and 50 paise per share, and 3,000 rupees per 1.5 * 2000. Net loss. Needless to say, after the square off, it does not matter where the futures price goes, as the trader has squared off his position. Also, 3,000 rupees per is debited from the trading account by end of the day. Now, let us just tabulate the value of the daily mark-to-market and see how much money has come in and how much money has gone out. Day ref price for M2M closing price daily M2M. The 1st of December 2014, 165,168.3 plus 6,600 rupees per. The 2nd of December 2014, 168.3, 172.4 plus 8,200 rupees per. The 3rd of December 2014, 172.4, 171.6, 1,600 rupees per. The 4th of December 2014, 171.6 and 170.1, 169.9, 3,000 rupees per. Total plus 10,200 rupees per. Well, if you summed up all the M2M cash flow, you will end up the same amount that we originally calculated, which is buy price equals 165 rupees per. Sell price equals 170 rupees and 10 paise per. Profit per share equals 170.1 to 165 equals 5 rupees and 10 paise per. Total profit equals 2,000 * 5.1 equals 10,200 rupees per. So, the mark-to-market is just a daily accounting adjustment where money is either credited or debited, also called daily obligation, based on how the futures price behaves. The previous day close price is taken into consideration to calculate the present day M2M. Why do you think M2M is required in the first place? Well, think about it. M2M is a daily cash adjustment by means of which the exchange drastically reduces the counterparty default risk as long a trader holds the contract. The exchange, by virtue of the M2M, ensures both the parties are fair and square on a daily basis. Now, keeping this basic concept of M2M, let us now move back to relook at margins and see how the trade evolves during its life. 5.4 Margins. The bigger perspective. Let us now relook at margins, keeping M2M in perspective. As mentioned earlier, the margins required at the time of initiating a futures trade is called initial margin, IM. Initial margin is a certain percent of the contract value. We also know initial margin, IM, equals span margin plus exposure margin. Each and every time a trader initiates a futures trade, for that matter any trade, there are few financial intermediaries who work in the background making sure that the trade carries out smoothly. The two prominent financial intermediaries are the broker and the exchange. Now, if the client defaults on an obligation, obviously it has a financial repercussion on both the broker and the exchange. Hence, if both the financial intermediaries have to be insulated against a possible client default, Then both of them need to be covered adequately by means of a margin deposit. In fact, this is exactly how it works. Span margin is the minimum requisite margins blocked as per the exchange's mandate, and exposure margin is the margin blocked over and above the span to cushion for any MTM losses. Do note both span and exposure margin are specified by the exchange. So at the time of initiating a futures trade, the client has to adhere to the initial margin requirement. The entire initial margin, span plus exposure, is blocked by the exchange. Between the two margins, span margin is more important, as not having this in your account means a penalty from the exchange. The span margin requirement has to be strictly maintained as long as the trader wishes to carry his position overnight, next day. In fact, for this reason, span margin is also sometimes referred to as the maintenance margin. So how does the exchange decide what should be the span margin requirement for a particular futures contract? Well, they use an advanced algorithm to calculate the span margins on a daily basis. One of the key inputs that goes into this algorithm is the volatility of the stock. Volatility is a very crucial concept. We will discuss it at length in the next module. For now, just remember this: if volatility is expected to go up, the span margin requirement also goes up. Exposure margin, which is an additional margin, varies between 4% to 5% of the contract value. Now, let us look at a futures trade keeping both the margin and the M2M in perspective. The trade details are as shown below. Particular details. Symbol HDFC Bank Limited. Trade type long. Buy date the 10th of December 2014. Buy price 938 rupees and 70 paise per share. Sell date the 19th of December. Sell price 955 rupees per share. Lot size 250. Contract value 250 * 938.7 equals 234,675 rupees per. Span margin 7.5% if CV equals 17,600 rupees per. EXP margin 5.0% if CV equals 11,733 rupees per. IM, span plus exposure, 17,600 plus 11,733 equals 29,334 rupees per. P&L per share, profit of 16 rupees and 30 paise per share, 955 to 938.7. Net profit 250 * 16.3 equals 4,075 rupees per. If you are trading with Zerodha, you may know that we provide a margin calculator that explicitly states the span and exposure margin requirements. Of course, at a later stage we will discuss in detail the utility of this extremely useful tool. But for now, you could check out this margin calculator. So keeping the above trade details in perspective, let us look at how the margins and M2M plays a role simultaneously during the life of the trade. The table below shows how the dynamics change on a day-to-day basis. I hope you don't get intimidated looking at the table above. In fact, it is quite easy to understand. Let us go through it sequentially. Day by day. The 10th of December 2014. Sometime during the day, HDFC Bank futures contract was purchased at 938 rupees and 70 paise per. Lot size is 250. Hence the contract value is 234,675 rupees per. As we can see from the box on the right, span is 7.5% and exposure is 5% of CV respectively. Hence 12.5% of CV is blocked as margins, span plus exposure. This works up to a total margin of 29,334 rupees per. The initial margin is also considered as the initial cash blocked by the broker. Going ahead, HDFC closes at 940 for the day. At 940, the CV is now 235,000 rupees per, and therefore the total margin requirement is 29,375 rupees per, which is a marginal increase of 41 rupees per when compared to the margin required at the time of the trade initiation. The client is not required to infuse this money into his account as he is sufficiently covered with AM2M profit of 325 rupees per, which will be credited to his account. The total cash balance in the trading account equals cash balance plus M2M equals 29,334 rupees plus 325 rupees equals 29,659 rupees per. Clearly, the cash balance is more than the total margin requirement of 29,375 rupees per, hence there is no problem. Further, the reference rate for the next day's M2M is now set to 940 rupees per. The 11th of December 2014. The next day, HDFC Bank dropped by 1 rupee per to 939 rupees per share, impacting the M2M by negative 250 rupees per. This money is taken out from the cash balance and will be credited to the person making this money. Hence the new cash balance will be equals 29,659,250 equals 29,409 rupees per. Also, the new margin requirement is calculated as 29,344 rupees per. Clearly the cash balance is higher than the margin required. Hence there is nothing to worry about. Also, the reference rate for the next day's M2M is reset at 939 rupees per. The 12th of December 2014. This is an interesting day. The futures price fell by 9 rupees per, taking the price to 930 rupees per share. At 930 rupees per, the margin requirement also falls to 29,063 rupees per. However, because of an M2M loss of 2,250 rupees per, the cash balance drops to 27,159 rupees per, 29,409,2250, which is less than the total margin requirement. Now, since the cash balance is less than the total margin requirement, is the client required to pump in the additional money? Not really. Remember, between the span and exposure margin, the most sacred one is the span margin. Most of the brokers allow you to continue to hold your positions as long as you have the span margin or maintenance margin. Moment the cash balance falls below the maintenance margin, they will call you asking you to pump in more money, in the absence of which they will force close the positions themselves. This call that the broker makes requesting you to pump in the required margin money is also popularly called the margin call. So, if you are getting a margin call from your broker, it means your cash balance is dangerously low to continue the position. Going back to the example, the cash balance of 27,159 rupees per is above the span margin, 17,438 rupees per, hence there is no problem. The M2M loss is debited from the trading account and the reference rate for the next day's M2M is reset to 930 rupees per. Well, I hope you have got a sense of how both margins and M2M come into play simultaneously. I also hope you are able to appreciate how, by virtue of the margins and M2M, the exchange can efficiently tackle the threat of a possible default by a client. The margin plus M2M combination is virtually a foolproof method to ensure defaults don't occur. Assuming you are getting a sense of the dynamics of margins and M2M calculation, I will now take the liberty to cut through the remaining days and proceed directly to the last day of trade, the 19th of December 2014. At 9:55, the trader decides to cash out and square off the trade. The reference rate for M2M is the previous day's closing rate, which is 938 rupees. So the M2M profit would 4,250 rupees per, which gets added to the previous day cash balance of 29,159 rupees per. The final cash balance of 33,409 rupees per, 29,159 rupees plus 4,250 rupees will be released by the broker as soon as the trader squares off the trade. So what about the overall P&L of the trade? Well, there are many ways to calculate this. Method 1. Sum up all the M2Ms. P&L equals sum of all M2Ms. Equals 325,250, 2250 plus 4750, 4,000, 2,000 plus 3,250 plus 4,250. Equals 4,075 rupees per. Method 2. Cash release. P&L equals final cash balance released by broker, cash blocked initially, initial margin. equals 33409-29334 equals 4075 rupees per. Method 3. Contract value. P&L equals final contract value, initial contract value equals 238,750 rupees, 234,675 rupees equals 4,075 rupees per. Method 4. Futures price. P&L equals difference BW, the futures buy and sell price asterisk lot size. Buy price equals 938.7. Sell price equals 955. Lot size equals 250. Equals 16.3 asterisk 250. Equals Rs. 4075. As you can notice, either which ways you calculate, you arrive at the same P&L value. 5.5. An interesting case of margin call. For a moment, let us assume the trade was not closed on the 19th of December, and in fact carried forward to the next day, i.e. the 20th of December. Also, let us assume HDFC Bank drops heavily on the 20th of December, maybe a 8% drop, dragging the price to 880 all the way from 955. What do you think will happen? In fact, can you answer the following questions? What is the M2M P&L? What is the impact on cash balance? What is the span and exposure margin required? What action does the broker take? I hope you are able to calculate and answer these questions yourself. If not, here are the answers for you. The M2M loss would be 18,750 rupees per equals 955 to 880 asterisk 250. The cash balance on the 19th of December was Rs. 33,409, from which the M2M loss would be deducted, making the cash balance 14,659 rupees per 33,409 rupees, 18,750 rupees. Since the price has dropped, the new contract value would be 220,000 rupees per 250 asterisk 880. Span equals 7.5% asterisk 220,000 equals 16,500 rupees per. Exposure equals 11,000 rupees per. Total margin equals 27,500 rupees per. Clearly, since the cash balance 14,659 rupees per is less than span margin 16,500 rupees per, the broker will give a margin call to the client. Or in fact, some brokers will even cut the position real time, as in when the cash balance drops below the span requirement. Key takeaways from this chapter. A margin payment is required, which will be blocked by your broker as long as the futures trade is live. The margin blocked by the broker at the time of initiating the futures trade is called the initial margin. Both the buyer and the seller of the futures agreement will have to deposit the initial margin amount. The margin amount collected acts as a leverage, as it allows you to deposit a small amount of money and take exposure to a large value transaction. M2M is a simple accounting adjustment. The process involves crediting or debiting the daily obligation money in your trading account based on how the futures price behaves. The previous day closing price figure is taken to calculate the current day's M2M. Span margin is the margin collected as per the exchange's instruction, and the exposure margin is collected as per the broker's requirement. The span and exposure margin is determined as per the norms of the exchange. The span margin is popularly referred to as the maintenance margin. If the margin account goes below the span, the investor must deposit more cash into his account if he aspires to carry forward the future position. The margin call is when the broker requests the trader to infuse the required margin money when the cash balance goes below the required level.